afraid in profit, hopeful in loss. The psychology of the investor who fears gains and clings to losses. In financial markets, a common but costly behavioral pattern appears. An investor becomes anxious when in profit and impatient to sell, yet becomes hopeful and stubborn when in loss, refusing to exit. This paradox is not irrational in a random sense. It is deeply rooted in behavioral finance. 1. The core bias, loss aversion. The concept of loss aversion was introduced by Daniel Kahneman and Amos Tversky under prospect theory. Their research showed losses hurt psychologically about 2x more than equivalent gains feel good. People prefer avoiding losses over acquiring gains. Result? When in profit, fear of losing the gain triggers early selling. When in loss, selling would realize the pain, so the investor avoids it and waits. 2. Prospect theory in action. Under prospect theory, people become risk-averse in gains, become risk-seeking in losses. This explains the behavior, situation, in profit and loss. Emotional state, fear of losing gain, hope of recovery. Typical action, sell too early, hold too long. The investor isn't evaluating probabilities objectively. They are reacting to emotional reference points. 3. The disposition effect. This pattern is known as the disposition effect. Selling winners too quickly, holding losers too long. It is one of the most documented behavioral biases in financial markets. Psychological drivers. Regret avoidance. Ego protection. It will come back. Anchoring to purchase price. Need to be proven right. 4. Why this pattern is financially dangerous. 1. It cuts compounding. Great investments often need time. Selling early interrupts exponential growth. 2. It locks capital in weak assets. Holding losing positions prevents capital reallocation. 3. It distorts risk management. Hope replaces strategy. Over time, this behavior can systematically reduce portfolio performance. 5. The emotional timeline. Interestingly, the emotional cycle often looks like this. After buying, small gain fear, small loss patience, larger loss hope, deep loss denial. The investor shifts from rational analysis to emotional survival mode. 6. Real-world reflection. During major market cycles like the dot-com bubble, the 2008 financial crisis, the COVID-19 market crash, investors frequently took quick profits during early rebounds, held collapsing assets, hoping for recovery. The pattern repeats across decades. 7. The deeper issue, identity and ego. Many investors do not just buy assets. They buy a narrative about themselves. I am smart. I saw the opportunity. This will prove me right. Selling at a loss feels like admitting failure. Selling in profit feels like protecting ego. The market becomes a psychological mirror. 8. How to break the pattern. Evidence-based solutions. Predefine exit rules. Set stop-loss and take profit levels before entering. Focus on process, not outcome. Judge decisions by logic, not short-term results. Use position sizing. Smaller risk per trade reduces emotional pressure. Track decisions in a journal. Writing reduces emotional distortion. 9. Final insight. The investor who fears profit and hopes in loss is not irrational. They are human. But markets reward discipline, not emotion. The shift from I hope to I planned is the difference between reacting and compounding.